What's going on, traders? Welcome back to another video. Sorry for my voice. I do sound a little bit sick. I caught a cold last night. I do feel better. I don't think it's the Rona. I am still going to get tested just to make sure, which is pretty interesting because we do have a lot to talk about today regarding the cases, regarding the scenarios for the markets, and the overall economy for the year of 2022, which, by the way, if you're watching this, Happy New Year's Eve, Happy New Year. Whenever you're watching this, we are probably in already a new year, so a blank page, a fresh start. Let's get right into the couple market scenarios which we could encounter next year. Let's start with the first one. We're going to start going with the rare cases to the more interesting reality cases. So bear with me with these cases. We're going to get right into it. We're going to try to go as fast as possible because the first ones are probably a bit boring. There's not a lot of action going on, and the rare, of course, which is the first one here is the rare stop, or the hard stop, I should say, which is, I think, could be rare. We already know why. The first question on here is, what are the Fed stamps inflation? Which we know it's probably not going to happen since they've said it's transitory. They've retired that term transitory, and they've taken so long to act on it, which I think is not going to happen next year. I don't think there's going to be a hard stop in which they do a quote-unquote Volcker 70 style attack in which they jam up rates. The market is probably 100%, in my opinion, going to collapse if that happens. So inflation is probably still going to remain high, and that's something we're going to be talking about in the next cases, which of course is going to lead to higher yields. It's going to destroy stocks, and the new strain is something we need to talk about. That's going to be a theme in every single scenario, because if you look at here, the wild cards, these are paradigms that we haven't had. We haven't had scenarios in history where we could kind of say, oh, this is somewhat of a 1950s, 1960s, 70s. The virus, I don't know if I should have said that. YouTube is a little soft when it comes to those type of keywords, but they can understand what I'm saying. The virus and inflation, those are the two biggest ones. And I may be pulling up the cases, which, by the way, are still or on their way back up. This looks like a stock chart. If you look at here, we have resistance around 800,000 cases. This is worldwide new cases. And out of nowhere, we have this massive rip. My guess would probably be people going out for Thanksgiving and the holidays and New Year's. People going out tonight. I mean, this is just insane. We're nearing 1.2 million cases a day here, 1.9 for December 30th. So this is probably going to go above 2 million. You guys decide what you guys want to think about this data here, and let's go right into the next key point here. We have, oh, where did this go? There we go. The Omicron, the new variant. This is probably going to be the new variant that stays throughout next year. Hopefully there isn't any new mutations of this strain that can definitely affect the markets, because you guys know how soft, how fragile the market really is when it comes to these variants. We've had many come and go throughout this year, but this is the one that is still lingering around today. And so much can happen, guys, in 1 year. It's very hard to predict the economy or the market in 1 year. A new variant could come out of nowhere that's worse than the Rona itself. We don't know. That's the only scary part. So this is the rare hard stop that the Fed jams up interest rates, which I don't think is going to be the case. But overall, the new strain and the Rona itself is definitely going to be something that's going to be playing into effect next year. Let's get right into the second one. This one is Stackflation, which is probably not the best for stocks, and bonds are probably going to be doing better or outperforming equities. Growth remains weak. Usually when we have a shift in the economy, it is first reflected in the jobless claims report, which is something that you need to also watch and keep on tab. This has been the lowest 4-week average since October 25. It's my mom's birthday, October 25, 1969. After growth here, we still have the inflation remaining rampant. Do we hit double-digit inflation on the CPI print? Which, by the way, take it or leave it. You guys let me know. Do you guys believe the CPI is manipulated? Which we're at 6.8% year over year. In November, we have that 0.8% jump. Energy is the highest. Gasoline is destroying it as well. Used cars, I believe, was also really high. Yeah, it's still really high. So let me know if you guys believe the validity in this. There's a lot of question about that among the investors. So we have inflation still above the Fed's target of 2%. And it would really take for them to take, it would really have to be for the Fed to take a big step in raising rates to combat inflation. So But of course, for this scenario, we have stagflation, which again the Fed fails to take action. The Fed is just sleeping on their computers, not doing really much anything, and delaying the overall effects of inflation. They're just watching it, basically, monitoring it, and not really doing much. Paul Volcker style. That's the way I think about it. You compare Powell to Volcker, two very, very separate people. Economists, I guess you can say. And the last one is investors flock to bonds for safety, which when I wrote this, and by the way, I combined a lot of the 2022 outlooks from banks: Morgan Stanley, BlackRock, Goldman Sachs, Bank of America, JP Morgan. I read all of them, and they all have different scenarios, and I try to combine them into 4 scenarios. When I read this, it didn't make sense because this is what I wrote here: bond nominal return is negative. Why buy bonds when you're getting wrecked by inflation and the nominal return is negative? But I guess you can say you have to park your money somewhere, right? Your money has to go somewhere, or else you're losing purchasing power. So I guess it makes a little bit of sense. The third one we have here, by the way, the market is indeed open right now as we're speaking, is probably our favorite scenario. Not reality, but one of the favorites. The market boom. The market boom is going to favor stocks and bonds. Equities are going to be green. The labor market's going to recover. People are going to be going back to work. Productivity is going to be increasing, all while the Fed is going to avoid a tight policy. We already know we're going to get 3 hikes next year. Tapering ends by March or April. That's out of the way. The market has, in a way, already priced that in. So I'm definitely going to be very interested to see how the market reacts. This market, which is very, very rate sensitive to the first hike. I'm very interested to see how that's going to play out. So the third bullet point is rates obviously are going to remain low to sustain valuations. You guys already know how that works. The cost of capital. Tech and growth stocks earnings carry us to new highs. This is another thing that's going to be playing out in January. Very, very interesting. January, we're going to have earnings. And we also have, I did not write this here, we have the Fed. We're going to have the Fed and earnings, which, by the way, if there's going to be one thing that's going to carry this market to new highs, it's not going to be so much that the rates are going to remain low. Yes, let's bring this up first. The money supply, why is this not working? And the S&P 500, oh, there we go. If you can see here, the S&P 500 line just went away. If you guys saw that here, there is a correlation between the money supply increase and the stock market increasing. So I don't know why that didn't work there, but if there's going to be one thing that's going to take us to new highs, it's not going to be so much low rates and the Fed that has been buying a bunch of these mortgage-backed securities and bonds, but the earnings. That's what we're going to fall back on. Earnings for big companies, the FANG, the Teslas, the Facebooks, the Microsoft, Amazon. That is going to justify these higher valuations. Also, I put here supply chain concerns easing. If there was one phrase that was common amongst earnings calls for this year, it was definitely going to be supply chain issues. And that's going to also be another guidance of how companies are going to be doing for 2022, and the forecasts. Keep in mind, a lot of companies didn't really do any forecasts or projections quarter over quarter. So that's going to be very interesting as well. Inflation, that guidance. Keep in mind that guidance. Inflation slowly starts to come off the high levels. Again, we don't know how high that is. The high levels, is it 10%, 12%? We don't know. But coming off the highs doesn't mean it's going to come back down to 2%. If you look at the inflation in the 1970s, it did come down, but guess what happened? It went right back up. And I think that was when the price control started happening as well. So keep that in mind. And this is all in a year, of course, where there are 3 potential rate hikes. Keep that in mind. It's going to be interesting to see how the market reacts to those rate hikes. Now let's get into our last one. This is probably my favorite one because I have it condensed here. Erase this. This is the reality case. This is probably our what's going to happen. So let's go right into it. Analysts are projecting another year of double-digit growth. So the S&P 500 has been going up since like 2018, which was like the last red year, almost down 5%, 31% in 2019, 18% in year-to-date. As of now, we're looking to close in right around 30% as well. So analysts are projecting another double-digit growth next year for the markets. Mild inflation, which is well above the Fed's 2% targets, which we talked about, is probably a common sense scenario where the inflation doesn't come back down to 2%. It still lingers around. See, I can't even give you a target. I don't know how high inflation can go. Yield curve is something we also need to mention. Essentially, the yield curve is just a graph plotting or showing you the different yields for different maturities, for different bonds. You have your 2, your 10, your 30-year yields. Trying to say that quick. But why is that important? First, we have the inversion, the inverted yield curve, where you have the shorter term rates rising faster than the longer term rates. And usually for the last, I think 7 times, if I'm not mistaken, don't quote me on that, that the yield curve has inverted, we've seen, and it has predicted a recession. So that's another one. The second one is a steepening of the yield curve. And this one is very interesting because usually when the yield curve steepens, that means that the spread between the long and short-term interest rates widens. Basically, the yields on the long-term bonds are rising faster than the yields on the short-term bonds. And what that's probably saying is that investors want a higher premium for their long-term bonds. And why would they want that? Maybe they're looking at the United States debt levels, the deficits. I know there's a typo here. The deficits that the United States government has been running, which is unhealthy at all. If you look at it from a company standpoint, which if you look at the government as a company, they're spending more money than they're making. Next one is negative nominal bond returns. Once again, you have to park your cash somewhere, or else your money is eroding due to inflation. And if you're going to be buying bonds, you're obviously going to have a negative nominal return. The next one is inflation eating away at your purchasing power. People are going to be flocking to stocks. This is one of my ideas that I threw in there. You have to park your money somewhere. Bonds, stocks, you decide. If you want to take the risk with equities, being double digit, again, like the analysts predict, double digit year for the S&P 500, go ahead and park it on the S&P 500 or whatever other stocks you want to cherry pick. But you have to park your money somewhere, or else you're losing money. And if you go to the stock market, what is likely to happen with the SPY or the market overall? It's probably going to go up, and we're going to be talking about the price targets of these banks, of these funds, at the end of this video. The next one is a short squeeze in the markets. There was a tweet, I wasn't able to find it, that stated that the short interest for the overall market was increasing, and this is what we saw back in October when the market pulled back. We saw another, in my opinion, that was another short squeeze. There probably is going to be some shorts piling in at the peaks, but what happens if those shorts get wrecked and they have to cover? That is just going to increase the overall trajectory of the markets to new highs. They're going to get squeezed, and that's something I think we've seen in September and October when the market pulled back. It felt like the sky was falling in October. It really did. It felt like, man, this is it. The market's going to pull back to 400, S&P 500. The market is pulling and retreating back. But no, it immediately bounced back to new highs. And look at where we're at today. We're closing the year almost at new highs. Talking about the sky is falling, the 4 corrections of 4% we saw in 2021 felt that the markets were falling. They felt like the sky was falling because we knew nothing but green. That is something that's going to be very important in 2022, especially at these exasperated levels, these high valuations. If we start to see a pullback, 5, 10%, God forbid 20, 30%, how are people going to react? Is the bubble bursting? Do you buy the dip? Buy the dip is a theme we saw throughout this entire year. Does that happen next year? Watch that. It's going to be very interesting to see it. And I'm going to be partaking in that and buying the dip, because I do believe that as the market pulls back, it's going to create very, very fruitful dip buying opportunities. The next thing we see in reality is the tech leads to new highs and carries the market's earnings power, higher price to earnings. Watch that. Supply chain constraints. Watch that for the earnings calls as well. And here we have the last one, which is the S&P 500 2022 end of the year predictions. Goldman Sachs predicts 9% to 5,100. Wells Fargo 11 to 12%. We have the double digit there. 51 to 5,300 for the S&P, and JP Morgan at 8% to 50/50. And all this is basically our reality case. Rates are still relatively low, is something they mentioned in their outlook, and driven by strong earnings. And then we have the S&P 500 bears, the ones who think the market isn't going to be pulling back next year. We have Bank of America, which thinks we have a price target of 4,600 for the S&P 500, and Morgan Stanley, which thinks 4,400, which is around a 5% decline. Bank of America says we have a dot-com bubble type of market here, environment. Dot-com bubble. Why do they think the market is coming down? High valuations, inflation, and a negative real interest rates. So those are the reasons they think the market is becoming down. I always respect the bears. I think they bring interesting perspectives to the table. They keep you grounded. As much as I want the market to keep going up, stocks only go up, right? The market never comes down. Buy the dip, everything's okay. As much as I like that attitude, you have to pay attention to why they think the market is coming down. Morgan Stanley thinks slow earnings growth and tightening scare. So they're throwing in that psychological aspect, which I love psychology. Tightening scare. I think that could somewhat be priced in already. The Fed came out saying they're going to stop their MBS, their mortgage-backed securities, and bonds purchases by the end of March. So I think that could be somewhat priced in already. The market went up when they claimed that. So I think what we really need to watch is the hikes, the rate hikes, which in a way it is a tightening, very hawkish. So I that's something I would put number one on my list, guys. Number one, the hikes. How is the stock market? If there's anything you're going to be watching that you can get away from this video, is this: how is the market going to be reacting to the rate hikes when they actually happen, when they come? That is my number one on the list. Number two, I would say, is inflation. Number three, earnings growth. So we have the Fed, we have earnings in January. It's going to be a very interesting month. There's also another thing called the January effect, which we'll probably cover in the next video next week. Sorry for not going live this week, guys. I did get sick yesterday and I felt really off. Usually I go live Fridays. I didn't feel, I just didn't, I stepped in, I didn't feel well. So I will be back though. I start classes next Monday for winter classes. I'm going to be trying my hardest to stream and to create content for you guys. And we will have a new video for the January effect coming next year, which is January. So if you guys found this video of any value, make sure you slap a like, leave a comment down below with what you think the market's going to do next year, and join our free Discord. Comments, link down in the description. I will see you guys next year.